This advice is general and does not take into account your objectives, financial situations, or needs. You should consider whether the advice is suitable for you and your personal circumstances. Before you make any decision about whether to acquire a financial product, you should obtain and read the relevant product disclosure statement. Hello everyone, my name's Patrick Malcolm. We are here for our annual podcast for the top investments for the year ahead. I'm joined here by our two senior financial planners, James.
Hello, Patrick. How are you?
James Malliaros, we should use full names, and Sam Eley as well.
Hey, Pat. How are you?
Really good. So just to start with, I guess the whole concept of today is about looking ahead and trying to predict the future. And we have a fun little game in the office where we try and predict the year ahead, both from a financial and non-financial perspective. And we did that last year, James, and we're also doing that this year. So the first thing we're going to do is we're going to review everyone's predictions, including the advisors that aren't here in the podcast. They don't escape lightly, Sam. And also talk about the predictions for the year ahead. So I'm going to start with you, Sam.
Yep.
And we get to discuss this investment today.
Okay.
So your financial prediction is you are optimistic about ResMed hitting $50.
Close but no cigar.
That's a miss.
Yeah, it's a miss. Did get up to 45, so got close.
Within
Got close.
10%, that's
Within
pretty
10%,
good.
Not bad.
It's
but
more accurate than my prediction, which we'll talk about in a
I
moment.
think that's probably a recurring theme. Both of mine were fairly close, the financial and the
Very
non-financial.
close.
So, ResMed didn't quite get there, dropped back into the 30s. And then on the non-financial side of things, I predicted that Geelong would be the premiers in the AFL Premiership.
You were
But,
close.
close, but again, no cigar.
Very
so tough
close.
break for the Cats.
I was a long way off, mate.
Well, probably was actually, to be
It
fair.
was a long way off.
James,
Yeah.
the Oracle,
Mate,
small caps.
I nailed them both.
So these are quite extraordinary.
So
Small caps outperforming large caps
Which it did.
strongly, very
Right.
strongly. And
Yeah.
this was a very obscure prediction.
Thinking left field.
Very
Patrick, as
left field, but I
usually do.
like it. James's non-financial prediction was regarding a public breakdown in the relationship between President Trump and Elon Musk, the resulting pressure on Tesla shares. Yeah, James, this is
Mate, it was never going to go one direction, wasn't it, really? Two alpha males having a go, butting heads, and eventually one had to crack, and it wasn't going to be Trump because he's the president.
yeah.
So, yeah, it was always going to happen. Even after he got his red Tesla at the White House,
Yeah, no,
I knew it was
that
going
was, that was on
It
that
wanted,
was,
it wanted white. That
It
was the
wanted
problem.
right.
at the beginning of the
It was
year.
only heading in one direction.
Now, we'll go through mine really quickly. Commonwealth Bank falling below $120. Bit of a miss.
Yes.
And I'm going to move away from golf predictions. I think I've done 3 in a row that have been very, very poor, so I'm not going to stick. I said that there would be a resolution to the BGA Tour and Live Saga. That didn't materialise. I think it's got worse.
Was the one stage they were going to.
They were close. They were
Yeah.
close, but it's gone
cigar.
downhill from there.
Yeah.
Now, our 3 other advisors. I don't know why Paul does this. He always doubles. If you notice, he always doubles up his predictions. There has to be 2 predictions, and he's got to get them both right to be
Yeah.
accurate. I don't know why he does this. So he expected a strong rebound in healthcare stocks and runaway domestic energy prices. Both, we should get the siren. Dun-dun. 2 fails there. And his non-financial big double were the Swans winning the AFL Premiership.
Jeez.
Yikes.
They make the 8.
No.
No.
Oh, okay. And Storm winning the NRL Premiership. That was close.
Oh, it looked good at one stage.
That looked very good.
And then some young Queenslander broke the back of their game.
Yep. Anyway, he's made things very hard for himself every year. And he's gone the double again this year. But anyway, Amelia's got some good predictions. She's sort of in the James camp here. She's a bit of an oracle. That the A-rate sector would perform strongly. Listed real estate. Did very good prediction.
Very good.
And she wasn't as quite as ambitious as Sam. She just said Geelong making the grand final.
Well,
So it's a tick.
technically
So I'm
she's
giving
right.
her giving her 2 ticks
She
there.
sits on the fence there.
No, I don't think she's sitting on the fence. No, I don't think so. No. Adam's predictions were about as good as mine. The big 4 banks would underperform. That actually didn't play out. There was some softness through periods throughout the year. ANZ, Westpac and NAB all delivered returns comfortably ahead of the broader market. Commonwealth Bank was closer to index performance. Now, I don't follow Formula One, so you guys will have to tell me whether this was right or not,
I don't know what
James.
you're talking about because I don't know.
Ferrari also fell short of securing the F1 Constructors' Championship.
Yeah, they didn't win.
Okay,
Yep.
thank you. So it wasn't. I think everyone failed both or got both.
Yeah, I think you and Amelia are the clear standouts, James.
Probably,
So
had a crack and, put it out
Nailed
there.
it.
Okay, so on to the predictions for the year ahead. Sam, yours. The worst performing asset class in 2026 will be listed property.
Well, I'm feeling a little bit, seeing the first rate rise
Yeah.
come through in February, coming off a pretty strong run last
Yep.
year. Perhaps if inflation's a bit stickier, RBA is forced to raise rates further, more than anticipated.
Yep.
I think listed property will be the one that suffers a little
Reversion
bit.
to mean? Yep.
Yep.
This is bold because if they end up finishing 1 and 4, it could be challenging, but I like it. An all AFL Queensland grand final, Brisbane and Gold Coast.
Well, Brisbane going for the three-peat. Gold Coast, I think, are primed now. With
Yep.
Petrarca in, a lot of pre-seasons into the good young kids. I think they're ready for the prime time, and I don't think the AFL could plan that one any better if they tried. So that's my guess.
Awaiting with bated breath on
Yes.
yours, James. While with the US dollar under continued pressure, emerging market equities will outperform other international share market indices.
Yeah, look, I think there's a sort of a direct correlation almost between US dollar devaluation and emerging market equities and debt doing pretty well. I think that's going to be the case. Obviously, the US market's outperformed for a number of years. And I think probably the scope of the returns from other international indices like emerging markets being that area around Southeast Asia and I think look fairly attractive.
Yep.
And clearly with the US dollar looking like it's going to continue to fall as interest rates are cut in the US, I think that's sort of a bit of a tailwind for emerging markets. It'll be volatile, but I think that they'll probably do better than the US and European shares.
And the beautiful game, the round ball, James.
Yeah, I'm a big fan of the round ball, Patrick. Over the years you've known me. I think there's always a little bit of a leg up for countries that are hosting the World Cup. I look back in 2002, I think it was, when South Korea and Japan co-hosted the World Cup, and they both, I think, made either the quarterfinals or the semi-finals. And I think the US is not a bad team. They've got a good coach who coached in the Premier League. And I think he'll probably get them through to around about the semi-final. I wouldn't be surprised.
Are we in their group?
Yes, we are.
Oh, okay.
So we do play the Americans, but I'd rather play them in the group stages rather
Okay.
than playing them in the knockout stages.
Yep. All right. So mine, global technology stocks will underperform broader markets as earning expectations normalise and capital rotates towards value and infrastructure assets. Again, this is a little bit of a value-based call that the tech stocks have run really hard. The infrastructure stocks have been very unloved, and I think there'll be sort of a cycling back to those sectors of the market. That could include healthcare as well, but I think the tech stocks have had a pretty strong run.
Yeah.
That's not to say don't hold them, but yeah, I wouldn't, and we've sort of seen it already, haven't we, with some of the software stocks. I'm going away from golf. I've said Carlos Alcaraz wins 3+ tennis majors. Now, I must say, when I made my prediction, he'd already won the Australian Open. So I'm effectively predicting that he's going to win 2. No, 2 of the next 3.
Yeah.
2 of the next 3. I think Grand Slam's very bold, but I think he could end up with 3 or 4.
Well, you probably give him the French, I'd reckon, and then he needs to win one of US.
That's how I thought about it, James.
Yeah, that's pretty logical.
Light work,
yeah.
easy.
Yeah, light easy, yeah.
Now, our 3 other advisors are Amelia. The ASX All Ordinaries will be above 10,000 points by the end of 2026. Not too far away now.
Touching
9
a bit
grand,
over 9,000.
9,000, just over 9,000.
10% from here.
Possible.
Yep. And Amelia's, she's gone one better with Geelong. She said Geelong to make the grand final last year. I think she barracks for Geelong.
She does, yeah.
I have to double check that. Geelong will win the AFL grand final.
Not sure. Not sure on that one.
Not sure on that one. Now, on to Paul. Melbourne residential property prices will fall again in 2026.
Selfishly hope not.
The horse named self-interest never runs second.
Right,
Sam.
That's right.
But look, with rates going up, and
I'm not so sure.
not so sure.
Yeah, Melbourne sort of underperformed over the last few years, and I probably think it's
For a
looking
long time.
and I think probably represents better value. So I wouldn't be surprised if you do start to see
Yeah.
some people buying back into the market.
I think the hard thing there is the investors probably aren't looking at Melbourne. Right? They'll be
No.
looking at other states.
No, the sentiment isn't great, is it?
So
No.
I think that'll be a bit of a
From a valuation perspective, it looks pretty interesting in terms of for investors, but then you add the extra tax and the compliance around state government laws, makes it really difficult.
It'd be pretty hard if house prices fell in aggregate across Australia for Melbourne not.
No, exactly.
Yeah. Anyway, and the double, non-financial, this is big. England to win the World Cup.
Yeah.
It's coming
It'll
on.
happen one day. It's been 1966, so it's going to happen one day.
One day.
It'll happen one day. Let's just hope it happens now so we're over and done with it.
Now, I must say, this is an interesting prediction. He said Errol Goulden wins the Brownlow. He hasn't predicted the Swans to win the premiership.
No.
So maybe with Charlie Curnow in the team, he thinks that's a foregone conclusion.
Maybe,
I think so.
Easy.
Yeah, easy. Yeah. It's too easy a prediction.
Errol, okay.
So Errol Goulden wins the Brownlow. I think that's a good prediction.
Yeah.
Coming off some injuries last year. And last but not least, Adam. This is a complicated one. Private equity will continue to acquire energy production and infrastructure assets due to the continued demand for AI and data centres. I'm not sure whether that's a statement or a prediction.
Sounds a bit more statementy to me. I guess you're kind of seeing a little bit of that with Cube, for example.
Yes. Yep.
So they're probably assets that are hard to get.
Yep.
So that would probably make some sense. But yeah, maybe more of a statement than a question.
That's okay. And non-financial, this is better. Jai Newcomb to win the Brownlow medal and the Hawks to finish top 4.
No, I'm not.
That's a big call.
Not so sure.
Someone has to be. There's so much football stuff in here. Someone has to be right, James.
Well, eventually.
Someone's got
to
to.
I stayed out of the football stuff being a Richmond supporter, so yeah.
You've had a good few years prior to those ones, James, so please don't complain.
We'll come back eventually.
Now, I think this is all a little bit of fun with the predictions for the year ahead, but it does sort of link to what we're doing here in the sense of when we talk about the top investments for 2026, James, I don't think we're talking about a single calendar year.
No.
Okay, we're talking about these investments being part of a diversified portfolio, and that now's a good time to include them in a portfolio, but we're certainly not making a prediction that these investments are going to make 200%. Okay, that's not the aim with this, is that these are the investments that we like at this stage of the cycle in a diversified portfolio. And just like predicting 12 months ahead with things like financial and non-financial, we can be wrong with investments. And some of the investments that we're talking about today certainly haven't had the best run in recent times, but maybe that means it's a good time to put them in a portfolio. So we will jump to the first investment. I am going to ask for people to disclose any conflicts of interest with these investments. Okay? So to the first slide, we've got Argo. Now, there's a potential conflict of interest here. Sam?
There is.
What is please explain the conflict of interest.
The conflict of interest is like many great things. Pie floaters, gather around, and myself. Argo, founded in Adelaide, South Australia.
And I believe, may be wrong, he was involved, but not the founder, Sir Donald Bradman?
Oh, God.
He was.
My Adelaide knowledge
sure
here.
He was.
I'm going to back you on that.
Yes,
1946, founded, so a bit 80 years this year for Argo. So, long-term listed investment company on the ASX. Actually, it's in the ASX 100. So it's one of the bigger companies that we actually have, within Australia. So
not quite 10 bill, but it's not too far off. It's big.
6.8.
Yeah.
So it's the second largest listed investment company to AFIC. So one of the bigger ones that we have on the ASX. So for those that aren't familiar with Argo, basically they're investing in a diversified portfolio of Australian companies. So typically hold somewhere between 80 and 90 stocks. Targeting, a bit of capital growth, but also one of the things that we really like about Argo and listed investment companies in general is that stable stream of fully franked dividends that it does pay. So when we look at listed investment companies as well, or any fund, you're also highly aware of cost. You want to make sure that you're getting good value for what you pay, and certainly that you've sort of seen that a bit over the last few years with the rise of index ETFs and the like. And one of the things that we do like about Argo is the fact that it does have a very low management expense ratio of 0.14%, which is very comparable with many of the index funds, but you're actually getting active management for that. So, that's something that we value highly. The active management, the manager being able to make active tilts in the portfolio, and getting that for the cost of just tracking an index, we think's quite valuable.
Yep. If we jump to the next slide, some other reasons why we like Argo. Sam, you've obviously spoken about the fully franked dividend.
Yep.
But can you talk us through the sort of concept of a discount to net tangible assets with a listed investment company?
Yeah, sure. So I suppose certainly one of the other attractions is when you're looking at a relatively expensive market, you're trying to find companies that look like good value. And one of the things with listed investment companies, or I guess a structural thing with respect to listed investment companies, is that they can trade at a discount to the actual underlying net assets of the company. So, for example, Argo is currently trading at about $9 a share. The actual assets, if they had to liquidate everything, is valued at over $10 a share. So you're getting, if you're buying Argo today, you're buying in at about a 13% discount. So like anything in life, we want to go shopping at discounts.
Yeah, absolutely.
Pick up some good value. So, that's one of the things that's attractive. And you mentioned before, Pat, about the income stream that it provides as well. So, based on current share prices, it's paying a fully franked dividend of about 4.25%. When you add the franking credit to that, it's over 6%, which is very attractive. It's a very strong income stream. When you look at the last sort of 5 years for Argo, the dividends have actually increased 37.5% over a 5-year period. So one of the things that we're very conscious of is not just income, but income that keeps pace with inflation and increases over time. So, having a listed investment company that can provide that fully franked income stream, which is particularly valuable for, the clients in the pension phase where they're getting that full refund.
Yeah, and without getting sort of too bogged down into the complexities of investing in a listed investment company versus an ETF, the predictable nature of the income stream as well with the ETFs, they can be quite unpredictable in terms of the income that they produce, whereas when you're buying into an Argo or an AFIC or a perpetual investment company, because of that company structure.
Yeah, very reliable, consistent dividend flow as opposed to an ETF that can be a bit more lumpy, more capital gains and distributions, also less franking typically as well. So, all those are reasons. So shopping at the discount, high fully franked dividend income stream with fully refundable franking credits for those in pension phase, and also just getting a quality diversified, actively managed portfolio.
Which we'll see on the next slide. You could see the
types of names that you see on in Argo. So many of those names will be familiar names for clients. Looking at that top 10, BHP, Macquarie Group, Rio Tinto, Commonwealth Bank, Westpac, Wesfarmers, Australian New Zealand Bank, CSL, NAB and Telstra. So, kind of the who's who, I suppose, of the ASX 20, if you like. And very diversified by industry. And as I said, this is sort of just the top 20, if you like, of Argo's portfolio. It does bat a lot deeper than that, down to sort of 80, 90 companies. But, a well-diversified, well-run.
And you can see it's
LIC.
active. Macquarie's not the second biggest stock on the ASX.
Exactly right.
BHP is, but that's an underweight exposure to BHP. CBA is close to 10% of the index, only got 4%. So you're not buying an index here. They are making
some active
bets, which is good. So we'll jump to the next slide. ResMed, James, any conflicts of interest to disclose here?
No, I don't use their products.
You're not a customer?
No, not a customer. No, maybe.
Sam and I just wanted to check.
Just double checking.
Maybe the age may sort of eventually get me there, but at the moment I have a good night's sleep, relatively good night's sleep. So look, I think it's ResMed's probably one of my, I think our favourite stocks, one of my favourite stocks definitely. It's just testament to Australia's ingenuity to come up with a company like ResMed that helps manage long-term sleep and breathing disorders. You look at quite a number of companies that that were founded in Australia. Although ResMed was founded in Australia, it's now domiciled in the US, I think.
Yeah, San Francisco.
California. Yeah.
So, but the whole thing in terms of companies like Cochlear, CSL, they're all Australian-based companies that do really that ingenuity came out of here. And I think ResMed is probably one of the leaders, and it is probably the leader in its field. And as I said before, it's really around helping people with long-term management of sleep disorders, breathing, respiratory conditions. It makes things like masks, ventilators, all sorts of other accessories, and probably the one that everybody knows about are the CPAP machines. And you're going to ask me, Patrick, what's a CPAP machine? And I've got it right here. I'm not a doctor.
You should have brought yours in, James.
Yeah, that's right. But the CPAP machine, CPAP, continuous positive airway pressure. Now, one of my clients is a doctor, and he knew that off by heart, and he told me exactly what it meant. So, they're fantastic equipment that really helps with all of that respiratory issues that many people have. And I suppose what really makes ResMed unique is that it's an integration of the hardware, the software as well, but also to things like consumables. Okay, so all of the stuff that you need to help you manage all sorts of sleep disorders and respiratory conditions, ResMed sells. And I think to the extent that you look at how ResMed is really sort of pervasive everywhere, is that everyone's got connected devices. Okay, so all those devices connect straight to GPs who can monitor how people are going. And so from the comfort of your own home, you use these machines. All of that information is transmitted electronically, and it goes straight to your doctor or your medical practitioner. So I think that's a wonderful thing around the technology that ResMed provides.
Yep. So if we jump to the next slide, so just in terms of the diagnosis. So you've spoken about the technology, James. I guess in terms of the addressable market for ResMed.
Yeah. So look, I think in terms of its addressable market is huge. Sleep apnea continues to be underdiagnosed. People just think that they're restless, they don't sleep very well. But sleep apnea is a condition, and it's a very debilitating condition, as many people would know. It can lead to all sorts of other medical issues, but it's very much underdiagnosed, and it's in terms of its addressable market, really only about 20% of sufferers are treated in the US. So there's a huge uptick for them, only 20%. So there are people who suffer from sleep apnea, but particularly in the US.
And the Ozempic sort of thing has gone away, hasn't it, James?
Yeah, look, I think in a couple of years, you'll see from the graph that's coming up later, ResMed's share price did get hit around the concerns around Ozempic, the GLP-1 drugs. The issue, I suppose, one of the issues that causes sleep apnea is obesity, and the market extrapolated the fact that once you start taking some of these anti-obesity drugs, people would lose weight, and the need to actually use those CPAP machines would go down significantly. But that actually been the case. What studies have found is that people who have lost weight are actually more in tune with their own health and actually get treated around, correct. Goes a co-treatment plan. So it hasn't been the CPAP machines and the weight loss drugs. They work together really, really well for your overall health.
Yep. So we jump to the next slide. In terms of the recent financial results,
the results
very strong.
Recently, February. It's for February reporting seasons. We know a lot of the companies come out and produce results. ResMed's results were quite outstanding, actually. Earnings up by 19% year on year. The mask and accessories revenue was up 14% globally, but actually more so in the US. And so they're starting to really ramp up their market in the US. Gross margin expansion was pretty much driven by efficiency gains, and supply chains became much easier. So they're able to make more money in every dollar that they sell of the equipment. And probably one of the most interesting facts in terms of their financials was that their return on investment capital has been about 20% per annum over the last decade, which is quite extraordinary. And that hasn't actually come from cost cutting. A lot of the big organisations, they cut costs to try and increase their margins. Actually, this has come from increase in sales.
Yep.
So they've done efficiencies within the business, but it's been an increase in sales, which has driven the average 20% return on capital.
And jumping to the next slide. I guess to summarise, James, very quickly.
So summarise very quickly, their major competitor, Philips, is out of the market. They had some massive product recalls, and the FDA, the Food and Drug Administration in America, is making life very difficult for Philips to get back in. They've got to do a whole bunch of recalls.
5 to 7 years ban from, I think it was 2024,
Correct.
From being able to sell CPAP and other sleep and respiratory devices. So.
And, they're at the forefront of research and development. So one of the things that they've got is that they continue to produce significant amounts of cash, and we know that cash is king, in terms of company. they're actually putting heaps of money back into research and development. And interestingly, they've got a new product which is called the AirTouch F30, which is a fabric-based mask. So rather than having a mask on you, it's just more fabric-based, which sort of obviously will make it easier for people to use.
Yeah. And then we look at the share price graph.
Yeah, the share price graph has been great to certain points. It got up to Sam. $45. Has come off and hasn't really been the sort of over the last sort of few months. It's been a bit frustrating, I suppose, the share price. It hasn't been really around any issues to do with ResMed, particularly. It's been just a sort of bit of a negative sentiment around growth stocks, healthcare stocks, which is
And
sort of
Aussie dollar too.
The Aussie dollar probably hasn't helped. They do hedge partly, but that hasn't helped. I suppose if you look back at the big dip back in 23, 24 is when the actual issues around those weight loss drugs first hit ResMed. But there was a strong rebound when they realised it wasn't going to make much difference to their earnings. But the share price has been very strong other than just of late over the last couple of months.
Yeah. So my stock, I don't feel like I've got any conflicts of interest to disclose with Amcor.
Sure.
No, I'm sure. I'm 100% sure.
Don't you?
So the next slide is Amcor. Sorry, the last slide on ResMed, James, which I think we've gone through.
Look, from the point of view, it's just the story's pretty good. Long duration healthcare tailwinds. We've got revenue visibility, high returns on capital, strong balance sheet, as we said, and the share price volatility, as we mentioned, is really more so around just sentiment rather than any operational issues.
Yep, agreed. So Amcor. This is not exciting. This is not an exciting business.
Yeah.
It's a global packaging business serving food, beverage, healthcare, pharmaceutical and personal care markets, predominantly staple and defensive categories. And the attractiveness with Amcor is around the non-discretionary nature of their sales revenue. So, not really impacted by the general economic conditions. Most of the things that they're supplying are staple in nature. The company's scale, global footprint and customer relationships create a very, very resilient earnings base. Package demand's tied to consumption rather than discretionary cycles, as I mentioned before, which is defensiveness. Okay, so we jump to the next slide. The share price has been knocked around a little bit in recent times, which we'll see from the slide a bit later on. But the second quarter results were really interesting. So revenue was sharply higher year on year, which takes into account the integration with Berry in the US. EBITDA and EBIT improved strongly, which is what the market was looking for. Free cash flow remains solid despite restructuring costs. So they've obviously had some restructuring costs in the business to do with the merger. Dividend was declared. Free cash flow guidance was reaffirmed as well. So things are all starting to head in the right direction. EPS growth moderated slightly due to those integration costs, which will wash out of the system in due course. But underlying operating momentum was extraordinarily strong, which is good. So we jump to the next slide. I guess the thing that's been weighing on the share price a little bit is the acquisition, Sam. So it became a much, much bigger business. Having said all that, synergies are tracking well ahead of expectations through efficiencies and operational consolidation. Now, this integration progress does reduce risk and provides benefits of scale. Obviously, with you've got a much, much bigger business, you should have better economies of scale. And one of the things that the market's been a little bit concerned with, James, has been the amount of leverage on their balance sheet. So they did take on debt for the acquisition. But this thing is an absolute cash beast. And there is a pathway to reducing that debt.
Which is important.
Very, very important.
And clearly, that's what the market was mostly concerned about with the share price, right? It's the combination of going, well, are they going to get those cost synergies out of that merger?
Yep.
And then, how high is the debt going to get, and are they able to clear it off in a timely fashion?
Yeah, which it seems as though they will do. So that strong and predictable cash flow generation supports a clear deleveraging pathway. So if we jump to the next slide, you can see the share price. The share price has been sick. Now, just for those people that can see the scale, I've had a few emails about this. There was a 5-for-1 share consolidation. So if you had 5 Amcor shares, that reduced to being 1 Amcor share, 500 turned into 100. So people look at the share price of $90 and mightn't be able to calibrate that in terms of where the share price has been. But it's been a challenging environment for the reasons that we were talking about before. Issues around the acquisition. There was some sort of stockpiling issues post-COVID that have sort of worked through. A little bit of a kick in the share price there recently, which is good to see. I just think you're getting a great business at a stupid cheap price, James. A stupid cheap price. The price to earnings multiple is low. Earnings growth is there, backed by a strong dividend. It just feels to me like a stock you could buy at the moment and then look in 8 or 9 or 10 years' time and think to yourself, geez, did I pay that much for it? Right? It's just it seems to be a very sort of easy path from this point forward for them.
So you said, like boring companies, but boring companies do really well.
That's exactly
particularly when
right.
they're the biggest in their respective field. So, it's just about good execution, really.
Yeah. And I think the executions, this companies do get penalised in reporting season for not delivering on expectations. Amcor prior to recent times have sort of been in that boat, but it feels as though the wheels starting to turn.
Sort of reflected in the share price uptick. You can see right at the end there, and I think the results beat market expectations, and the share price has been rewarded. It's about continuing execution.
Yeah.
And I think they're doing all the right things, particularly around the berry synergies.
Yeah, it's a recession-proof business.
Industry. And sometimes you just need those kind of really sort of relatively boring but good defensive stocks in the portfolio.
Or any of those sorts of companies. It's just solid.
It's not an AI stock. It's pretty honest. Yeah.
We're going to get to the exciting stuff.
We are. So if we jump to the next slide, share prices underperformed, lower packaging volume, sector rotation, integration caution, and the gearing. And sometimes the underperformance is just a good time to get in. Yeah. The valuation derating it's more around. So share prices only move for 2 reasons, either earnings or multiple expansion or contraction. This has all been around multiple contraction, i.e. people aren't prepared to pay as much for $1 of Amcor earnings. It feels the risk to reward ratio on this stock now is significantly skewed in favour of the reward relative risk. That's not to say it's a guarantee, but when we look at stocks, you're thinking about what can go right from here and what can go wrong from here. It feels like more can go right for Amcor than can go wrong.
Yeah. I think they're at an inflection, a turning point, I think, for the better.
Feels like that. Yep, let's hope so. Next slide. We'll jump on to Munro. So what have we had? We've had Argo, Australian. ResMed, I'm going to call it Australian,
somewhat
but Australian's an international.
Exposure,
and Amcor's probably a global business.
Yeah, it is too.
So we've had a bit of a mix, but now we're jumping to a pure international share fund, Sam. So talk us through Munro.
A little bit different, yeah. So Munro Partners are a Melbourne-based firm, but investing in global growth equities. So, they're relatively high conviction, so, 30 to 50 stocks. They're an absolute return fund, so they're not benchmark aware. They're not trying to track an index or any of that sort of stuff. They're making calls based on, I guess, where they see the world. In some ways, you might view this fund as somewhat thematic, which we'll get into in a minute. But, really, they're focusing on those structural growth companies in the big mega trends that sort of they see playing out over the next 10 years. So, I guess when you're looking under the hood, like Munro's process, they're focusing on companies where they're constantly revising earnings up. So, obviously we want those. Good, earnings momentum, in industries that they see are, continuing to be forward-facing and growing at a good rate. So, one of the things that we like about Munro is they are active. So, in comparison to buying sort of a global index or something like that, where you're just paying whatever price for whatever the index is doing. Munro has a bit more discretion around how they're going to manage the portfolio itself and put in some protections in place, which again for clients, we like downside protection as well. It's very important. Yes, you want to participate when markets are going well, but you also want to try and protect your capital in times when inevitably they won't. So. Munro uses a number of tools like, one, just holding excess amounts of cash.
Put options.
Put options, that's right, shorting.
Yep. Hedging currency.
Exactly right. So all those sorts of tools are at their disposal to try and protect client
As
capital.
opposed to just owning or not owning a stock and
And
owning.
you're just riding the wave
Yeah,
what'll be will be, right? So at least you're having a bit of overlay on that.
Yeah, and I think it's a perfect example of an investment that complements other existing investments in your portfolio as well, because it's doing something a little bit different. So if we jump to the next slide. So the areas of interest, Sam?
Yeah, so we touched on that this is kind of a thematic type fund. So Munro's areas of interest, as we sort of said, are focusing on those big global megatrends. So things like high-performance computing. So that's stuff like artificial intelligence, semiconductors, cloud infrastructure.
Yep.
You then got sort of the climate element through electrification and decarbonisation, connectivity, digital media, innovative healthcare, and industrial automation being the other sort of areas of interest that they're exploring at the present time. And clearly, as things evolve and change in the world, they will then consider adding further areas of interest into that. But that's sort of the focus at present. So they view these as sort of big industry structural growth changes that are occurring. So Munro is not necessarily overly interested in the economic cycle. It's about where are these trends going?
Yeah.
Who are going to be the winners of these trends, and can we get investing and get that sort of compound growth over time?
Yeah, sounds really easy in concept. It's actually hard. It's actually quite hard to do, to think about the themes that are going to change the world and
the next 20, 25 years. Yeah.
I think you'd be hard pressed to look at those 5 themes and not see them as massive massive trends coming in the next decade plus ahead.
Definitely agree.
And you're already sort of certainly seeing it play out with AI. And decarbonising and electrification of vehicles.
And to the next slide. So just to summarise Munro, Sam?
Yeah, just to summarise. So, we've talked a fair bit about domestic equity so far, but
you just don't get this innovation in the domestic market here.
You're not. We know that Australia's the land of banks and miners and defensives and all that sort of stuff. So you're getting exposure to sort of those trends that don't really play out here domestically. Clearly, these companies have high earnings growth potential. You're talking about companies like NVIDIA and Amazon and Alphabet and all those sorts of large growth companies. As we said, structural rather than cyclical, so not necessarily based on the economic environment of the day, but just about long-term structural trends and the fact that they've got those risk management tools in place to protect capital in times when inevitably markets aren't being kind.
Right. Next one. Next slide. Something a bit different, James.
Yeah, look, this is a bit different here. Obviously, we know that that the commodities and resource sector is probably the flavour of the month at the moment. Has been for the last few months. We've seen prices of BHP, Rio, companies like that have gone through the roof. I suppose what we like particularly about this particular fund, managed fund, the guys run it from Perennial, is the diversification you get in the resources and commodity sector, okay? And notoriously, if you pick the wrong stock here, you can do a fair bit of damage to your portfolio, okay? And so what we're using is the expertise of these guys from Perennial that actually go and see how these companies operate. But they also actively look in as well as resource companies, they look at actually commodities and putting commodities through their portfolio as well too. What we particularly like is that in their mandate is deliberately flexible, allowing them to invest across different things like precious metals, bulk commodities, battery materials, energy, and specialist resource infrastructure. So I think that's the great thing about this fund. It gives you great diversifications across all sectors of the resource and commodity sector.
Yeah, because owning probably BHP and or Rio Tinto isn't enough.
That's right. There's resources and minerals beyond that are needed for industry that you're not going to get from companies like BHP and Rio Tinto necessarily.
Yeah.
So we like that. I think that's what we particularly like about this particular fund. It is a bit of a niche fund, so it's not something that you would put a lot of. You'd put a really heavy weight.
Yeah,
but it's an important thing to correct.
It's sort of edging up to maybe 4%, nothing silly.
4 or 5%, somewhere around there. But it's an important thematic, I think, which will continue to play out in the future. And we'll explain a few reasons why as we come up to the next few slides. Look, I think from the point of view is that why do we like this fund here? Because there's a number of sort of 3 or 4 different factors that we think are going to drive the resource intense demand going forward. First one is geopolitical fragmentation. We all, it's a we all love
Say that
geopolitics.
5 times quickly.
Geopolitical fragmentation. It's basically every country for themselves at the moment. We used to, correct. Every country's looking after their own needs now, and particularly around some of the rare earths and some of those particular types of commodities. China's a massive player in it, the biggest player in the world, and I think countries are looking to diversify their demand away from China and other countries around the world. And Australia has a very much a strategic advantage that we produce most of the periodic table, as Anthony Albanese once said, okay? So I think from that perspective, a lot of countries want to go on themselves. They don't want to be reliant on another country for these kind of critical minerals. Yeah. The second one, as Sam talked about in his with Munro, is electrification and decarbonisation is happening. We are moving slowly to a world where we've got burning less fossil fuels and we're using more electrification and decarbonisation. And those essential minerals and commodities are needed for that transition. It's pretty simple. Copper, lithium, those kind of resources.
You saw that with BHP's share price recently.
Yeah, correct.
Their copper exposure.
It was mainly due to copper, not iron ore. Correct.
Which is, you wouldn't have read about that.
And so one of the other things that they've actually got in their portfolio, and they've got a very large allocation to, is gold. And we've seen the price of gold shoot up, primarily as central banks around the world. So we're talking about Reserve Bank or the Federal Reserve in America, or number of different central banks in the world. They're trying to reduce their weighting in US dollar assets. And so they're looking at gold as something to diversify their holding of financial assets. And gold has been very much the flavour of the month. And there's also an issue around volatility, uncertainty, geopolitics, and people always tend to go back to gold. And so they've got a very large allocation to gold, which they're managing very carefully. And one of the other factors is also the obvious supply and demand. Okay, there's
been an underinvestment.
Correct, for years and years, because there hasn't been demand. Correct, prices were lower. There was been no demand, and so therefore there's been no supply. Now all of a sudden demand's got up, supply hasn't kept up, and the need for and the price has gone up.
Yeah, and when these sort of a trend like this emerges, as we've seen in the past, James, without sort of putting the kiss of death on it, generally goes for a pretty long time.
It does.
Yeah, it's not like old resources outperform for 3 months. You can see a sustained period of outperformance. And look, I think the other thing that we like about this too, James, is to the earlier point, not just owning BHP and Rio. Nothing wrong with BHP and Rio, but this sort of crosses the whole resource and commodity space.
Yeah. And so never said is if you pick the wrong stock there, you could get a bit of a hit to your portfolio. So you're allowing these guys to actually do the active management and pick the companies that they think.
It's still reasonably diversified. 20 to 70 companies in the portfolio. They've got pretty wide breadth there.
Yep. Correct. So Goodman Group, this company's changed.
Yeah. Certainly has, yes.
Yeah. You would have called it an industrial property developer a little while ago. It's certainly not that now.
No.
So it is now a global owner, developer, and manager of logistics and digital infrastructure assets. The business operates via a capital light partnership model, co-investing alongside institutional capital while earning recurring management income. And as I mentioned before, the group is transitioning from a traditional industrial REIT towards a global digital infrastructure development platform. This is now one of the 10 biggest stocks on the ASX.
Yeah.
So this is often one where you do catch clients by surprise, where you say this is now in the
actual size of the business.
Yeah,
been a bit of a theme in today's thing. Global sort of Australian companies that are more global facing,
which is good to see. Good to see. So if we jump to the next slide, sort of half year results to 31 December, operating profit of 1.2 billion. Earnings per share 58.5 cents. NTA went up and distribution of 15 cents. The earnings mix reflects development timing with second half weighting expected. So this was only the 6-month result. Their results are a little bit back-ended, so the second half will be stronger than the first half.
They've had a pretty good history of revising up.
Yeah.
Let's hope that happens.
That's exactly. Yeah, surprise. They do tend to surprise on the upside. So if we jump to the next slide. So this whole story with this space is around digital infrastructure. So they've got a 6 gigawatt global power bank, 3.6 gigawatt of secured power. 73% of their work in progress is data centers, and that's worth $14.4 billion, targeting $18 billion by June 2026. And this is pretty simple in this space. power availability and land scarcity are massive barriers to entry.
Yeah.
If you don't have power availability and land scarcity and both of them, you can't play in this space. And AI and cloud infrastructure expansion underpins multi-year demand. So if we jump to the next slide.
I think the big box infrastructure that they've got lent itself to the data centers and the like. I think they can easily convert into data centers where industrial storage becomes data centers pretty easily.
Yeah. And I think this is really interesting in terms of the portfolio. 96% occupied. Whale, which is not the whale in the sea, weighted average lease expiry, 5 years. Rents went up 12%. Gearing's 4.1%. That's nothing.
Compared to so many of the REITs.
Yes.
Chalk and cheese.
Yeah, and that's that capital light model as well, Sam. Yeah, using other people's money to make them and make money for shareholders, which is great. And liquidity is $5.2 billion. Make no mistake, this is one of the best balance sheets of any company in the world, which is what you want, right? You want to know that a company's got a strong balance sheet behind it when operating in this space.
Just the owner and the people in the management running the company.
Yeah. So look at trades. It's not cheap on a price to earnings basis, but it's all about the growth. But it's not a traditional REIT. You can't compare this to the price to earnings ratio of a traditional REIT. It's just not right. It's a global digital infrastructure developer now. That's what it is. With what I would describe as being now embedded structural growth. They do have a strong history of execution, as you pointed out before, Sam. They do what they said they were going to do, which is what you like to see with companies. There are companies that continually disappoint. Touch wood, Goodman is not one of those, and it does have one of the strongest balance sheet. This is a long duration structural growth stock tied directly to AI, cloud, and logistics infrastructure.
Very much feeding into a lot of those other themes that you're talking about, really. Yeah. In some ways perennial as well, right?
Yeah.
Just in different ways.
Exactly.
With that industrial portfolio, we haven't focused on that much, but that's sort of good bones of the business, if that makes sense. Yeah. So if we jump to the next slide, there's the share price. Had a good little run, has been softer in recent times. I think you're getting an entry point at around that $30 mark.
Which is very attractive,
I think it's great. I think it's great. I think it's a very attractive entry point at current levels. You haven't been able to get the share at that price in a couple of years. So on to the next company. Not company, fund, the Barrow Hanley Global Share Fund.
So an exchange-traded fund, investing internationally. So it's my last one of this podcast. But I think it's a really important one that clients should hold in their portfolio because it provides you great diversification in that international space. And particularly, I suppose, when you put it against Munro, which invest in that AI theme and some of the biggest technology businesses
some of the biggest companies in the world.
Correct. So, we talk about the Magnificent Seven. Well, these guys do things a little bit differently, okay? So they diversify into other areas of the market, which are a little bit more value-based, which represent, rather than being growth businesses, they're based on valuations. And they're trying to get in at a particular point of the valuation where they think it's very attractive.
Yep.
And so we've had this ETF on our list for a little while now, but we're starting to put it more and more into our clients' portfolios because we think now is a pretty good time to actually diversify that international space and complement some of the other investments that we've got in international space with something like this, which is more value-based.
I think that's a really good point that something like this and Munro blend very well together. There would be almost no crossover of stocks.
Exactly.
It's a bold call, but I don't think
you'd be
correlation
right on
correct.
Yeah, and they're doing slightly different things.
Correct.
Too.
And that's the reason why you diversify, because you don't know what's going to happen in the economic cycle or the investment cycle. And one of the reasons why we like this. Look, it's 50 to 70 holdings, pretty much standard across most international funds. One of the second bullet point there says intentionally seeks mispriced companies trading below their intrinsic value to temporary earnings pressure or market overreaction. So if things have been sold off, I think they use that as a point of entry to get into certain good quality stocks.
Yeah.
All right.
Next slide.
one of the things we said, global equities indices remain highly concentrated. So we talk about the big tech businesses and the Magnificent Seven. And I've got a little bit of a stat here, which I think you already know, Patrick. But anyway, we'll put it out there. The Magnificent Seven, the big 7 technology stocks, make up a third of the S&P 500 index. So a third of it.
Third of the S&P 500.
Yeah. So the other 93, so the other 493 stocks make up, 2/3 of it.
Yeah, we had the Magnificent Seven. I think there was an acronym for the other 493 companies.
Correct.
That wasn't very nice.
That's right.
But that's okay. We won't need to go into that.
And most interestingly, though, in 2025, in the calendar year 2025, those Magnificent Seven, the big 7 stocks, actually resulted in 50% of the gain in the S&P 500.
Yeah, wow.
It's interesting that. But then if you cast your mind back a couple of years earlier than that, right, when inflation was running rampant, all the big tech stocks all sold off aggressively, right? They were down 30%. So this comes back to the point about diversification, right? We're trying to build all-weather portfolios.
Yeah.
It's great that they've had an amazing run, and that's why you've got your Munros and those types of guys in the portfolio, but there's got to be a place for the Barrow Hanleys to pick the eyes out of the other, 2/3 of the market.
Right. And so one of the things that their investment approach really involves around companies that have got lower earnings multiples. Importantly, like we've talked about before, cash is king. Free cash flow is really, really important for the business. Balance sheet resilience, so low debt, cover interest obligations, and potential for mean reversion, which actually means that the company will actually will trade back to its proper valuation.
Either it's trading on a depressed multiple or earnings are lower for a period of time, and those things improve, and then suddenly the share price follows that.
Exactly right. All right, next page.
Next slide.
Yeah. And so one of the reasons why we like Glob is it complements growth exposure, as I said, with Munro, with what Sam talked about, reducing concentration risk, diversifying factor exposure, providing cyclical recovery. So it means that different types, recovery, when markets are recovering from, different investment cycles, they'll participate in that, and enhancing downside resilience. So effectively, you want to diversify your portfolio to protect your downside. And I think this particular investment provides that.
Like you said, it's about that balance.
Correct. It's all about balance and diversification. You don't want to be investing internationally the same stocks across 3 or 4 different funds. That's useless. You need to diversify different types of stocks across different sectors and different geographies as well too. So they invest in other parts of the world that maybe companies like Munro wouldn't invest.
Yep. So we jump to the next slide. It's heading into a very different direction. The Perpetual Pure Microcap Fund back to domestic.
So I need to disclose conflicts of interest here as well.
Do you own this investment, Sam?
No.
No, okay.
Then I don't.
No.
Perpetual's a reasonably, it's a fairly household name in the Australian market, I would have thought. Probably mostly known for the industrial share fund and credit.
Yep.
More so than perhaps global equities and other areas. But microcap has been around for about 12 or 13 years now.
Yep.
So, when we're talking about microcaps, we're talking about companies in Australia with a market capitalisation under 300 million. So, you sort of got your large caps, your mid caps, your small caps, and then your micro caps. Okay, so hunting down here, they tend to be a bit more volatile, by nature. So when we're looking to invest in something like the Pure Microcap Fund, it's generally going to be a smaller allocation to your overall Australian equities profile. Very much more focused on growth and income.
Yep.
Perpetual's process when analysing companies, I suppose, down here in the microcap end of the spectrum is bottom up. So by that, we mean that they're going out and visiting management directly.
Which is great.
So they're not sort of necessarily looking at the macro factors initially. It's about meeting with management, determining their quality, the sustainability of the business and its balance sheet strength, and then they'll build the portfolio out from there based on their convictions. We all know Australia is, as we said before, sort of the land of banks and miners and defensives and things like that. But micro-cap companies tend to be in
the big end of towns like that, but it's far more diverse.
Yeah, when you get further down that market cap spectrum, as you're saying there, Pat. So, micro-cap will give you a greater degree of diversity than just investing purely in the big blue chips.
And this is not. I think the really important to note is there's lots of junk down there, right? And we call them, we describe them as stocks with binary outcomes in the sense that it's either very, very good or very, very bad, and far more skewed to the very bad happening rather than the very good. Perpetual avoids those sorts of
Well, the
businesses.
screening process is as we know.
There's lots
It's
of
just
junk,
top class.
mining and biotech companies at that end of it. They sort of filter out, which I think is really, really important.
Yeah.
From a fund perspective, they can hold 30 to 50 stocks.
Yep.
So, pretty well diversified and up to 30% cash at times as well when the
I think
market
valuations
turns.
are stretched.
Yeah, when the market's not looking as
So if we jump to the next slide, performance since inception, Sam.
very strong.
Yeah, 17.
17% per annum.
Which is incredible. That sort of means you're doubling your money almost every 4 years.
Yeah.
Yep.
Yeah. And, importantly, this one is benchmark aware. So looking at the benchmark, the Small Ordinaries Index over the same time period has done a bit over 7%.
Yeah, wow.
So, you're getting close to 10% per annum.
Strong case for
outperformance.
active management in that space.
Very strong.
More than double the return of the index.
Yeah, that's right. And likewise for in more, that's the long-term track record. In the more recent 1 year performance is 27%, so very strong. Smaller companies' valuations looked probably more attractive than the larger during that period.
Yep.
But again, versus the benchmark, which did around just under 20%, you still got some good alpha over the last 12 months. So, so that was very strong.
I think the really important thing to note with an investment like this is to be there through the cycle with it. This investment, when markets are tough, this part of the market can get knocked around even high-quality companies.
It did for a short period of time,
underperform large caps quite significantly, but this is an investment you put in your portfolio and think, I'm going to own this for a long time, and you'll be rewarded for owning it for a long time.
Just so we'd mentioned before about upside and downside capture ratio. So looking at the fund, over 90% of up markets has been captured.
Yeah.
Only 60% of down markets.
That's what you want.
So, in this, like you said, volatile part of the market, but at least you're getting good capital protection mechanisms there and still participating when markets are running.
Exactly right.
And which has driven the outperformance.
Yeah, they're very strong numbers. So we jump to the next slide.
Yeah, I think just in summary, basically, it provides exposure to emerging Aussie growth companies, different types of industries than what represent the large and mid-cap part of the market. Good alpha potential, so high capital growth potential as we've seen over their long-term track record. But again, we're very mindful of positioning size with a business like
this is probably
a fund
2
like
to
this.
4% in a client's
Much like
portfolio.
perennial, right? It's that sort of little satellite exposure gives you that extra bit of punch.
But it's an important diversifier, I think, in our portfolio.
Absolutely, because you're getting exposure to different sectors than you do get in the large cap space in the Australian market.
Right.
Absolutely.
So if we go to the next slide, I'm not sure how I've ended up with fixed interest again this year. I got bombed last year, James.
Rock, paper, scissors, you lost for the first time. You didn't stitch
I
it.
lost rock, paper, scissors. Got stitched up here, tacked. Goodness me. Okay, look, I think we would describe all of the investments in the portfolio to varying extents as being growth orientated in nature, i.e. they're share or property investments that you expect to appreciate in value over time. Now, we know the concept of total return is income plus capital growth.
Mm-hmm.
There are some investments that are more income orientated in what we spoke about, with Amcor being the perfect example, i.e. if Amcor gets you 9 or 10%, you're probably expecting, more than about half of that to come from income. Whereas, with a Goodman or ResMed, it's really about share price appreciation, right? And all those investments are wonderful, and you're often rewarded for owning them for a long time. But for people that aren't high growth investors, you've got to have something in there that defends the portfolio a little bit when times are tough. And this is where TAC comes into things. So TAC's a fixed interest investment, allocates to government bonds, investment grade and high yield credit and securitized assets. And this is actively managed, like we were talking about before, James.
Yep.
Portfolio positioning is driven by relative value, income opportunity, and downside management. The mandate is unconstrained, which we like in this space. One of the problems with investing in an index in this space is you get allocated to the most indebted countries or the most indebted businesses, okay, which sort of is a little bit counterintuitive,
You don't
isn't
want
it?
that.
No, you don't. You want
in
to
this
be
particular space. You want active management to pick out the best types of investments there.
So it's unconstrained. They can go wherever they like. This allows duration management and sector rotation depending on what they perceive the macroeconomic conditions to be.
Mm-hmm.
Yeah.
And this flexibility differentiates itself from those passive bond exposures that I was talking about that are tied to indices. So if we jump to the next slide, So after one of the most aggressive global tightening cycles in decades, bond yields now, James, are actually at quite an attractive level.
Yeah.
So you're getting attractive income carry. What does that mean? It means you're actually getting income on their portfolio. Was it bonds, end of 2021, Australian government bonds, 1% or something like that. There is the potential for capital appreciation with this as well. So I often describe an investment like this, Sam, as being a little bit of an insurance policy in your portfolio. Hey, look, if things don't go to plan and the economy goes off the rails either here or overseas, this investment will pay you your income. But if rates fall, you can also pick up a capital gain from this investment too. And I think we're now in an environment where the risk reward, or I guess the risk adjusted return you're getting from this asset class is better now. So why on earth would you buy government bonds when rates were 10% or 1%? Okay, they can only go in one direction. That's up.
Yeah,
you get a capital loss. It's just silly. So there's just no benefit. So credit spreads are contained, but there are opportunities that exist in other parts of the market too. So we jump to the next slide. So in terms of summarising tact, income generation, capital preservation, diversification with equities. The idea of owning an investment in the portfolio like this is that it doesn't perform in line with equities. It performs different to equities, and you're hoping that it provides a positive return when the rest of the portfolio might be struggling, which can happen from time to time. And that all comes about through lower correlation, that they don't behave one for one.
Yeah.
And in a balanced portfolio, fixed interest exposure reduces volatility while maintaining total return potential in easing cycles. I can promise you both, I am not doing a fixed interest investment. It's on you or Paul. But you need it in a portfolio. It's just not very exciting. I've got Amcor and Tact.
Yeah,
that's right.
Too defensive. Well, you need a fixed interest exposure, correct? You need, particularly fixed interest exposure, to pay out a decent, reliable yield on an ongoing basis, a regular ongoing, yield. But you need something that if equity markets do get hit around, there's going to be.
And the whole idea is these investments complement each other well.
Exactly right.
It's much like we're talking about building diversified growth portfolio. On the fixed interest side is just as important,
Absolutely.
right? You want to build a core, maybe Tact is the core, and then you've got other types of investments.
Yeah, some hybrids around it.
Some corporate
credit,
debt, other things like that, where you're trying to get a well above cash rate of return overall from your fixed interest exposure while manage the downside. So
particularly for clients that are looking for yield, looking for income, I think this asset class is really important.
Rates are at least probably staying similar. Yeah. Some debate about whether it's going up or down, right? But if, again, rates go up,
but you've got
equity markets might come off a bit, but you're getting more income.
You've got the income carry to protect yourself there. So, James, thank you for joining us today.
No, it's a pleasure, Patrick. Always good to catch up.
Await your predictions with bated breath. How far is the World Cup off?
Mid-June, so not long to go.
You got tickets?
No, I'm not going to the US. I think my social media pages wouldn't allow me to get in.
And your sporting, that was your sporting prediction, and your non-sporting, which was not financial?
Emerging markets.
Emerging markets, we'll keep an eye on that.
Yep.
Sam, thank you for coming in.
Thanks, Patrick. A pleasure.
Your predictions?
All go Queensland, I guess.
Clash Grand Final.
Q Clash Grand Final. They might just have to move it from the MCG up to...
No, that won't happen. And financial?
What was my financial?
A-REITs not doing well.
Oh, A-REITs. Yeah, I guess we'll see. Subject to where rates...
I think you've got off to a good start with that one.
Yeah, I think subject to where interest rates are going. Rates go up, generally A-REITs are probably going down. So let's see what happens.
And for me, Vamos, Carlos.
That's it.
Vamos, Carlos. And my financial prediction...
Hard assets, infrastructure.
Yeah, outperforming or the tech stocks finding it a little bit hard. So I feel I'm ahead of that curve too. So
I think you could be there.
Anyway, thank you guys. Really enjoyed it.
No, it was a pleasure, Patrick. Thanks again. Thanks, Sam.
James.